Good afternoon. It's my great pleasure to welcome you to this afternoon's event on the Biden stimulus, the Federal Reserve, and the everything bubble. It's my particular pleasure to welcome our highly distinguished panelists who will bring a great deal of expertise to this topic. In the order in which they'll speak, they are Jeffrey Frankel, who is the James Harpel Professor of Economics at Harvard University's Kennedy School. Jeffrey is also an associate member of the National Bureau of Economic Research, and he has served on the President's Council of Economic Advisors. Jeffrey will be followed by Fabio Nattalucci, who is Deputy Director of the IMF's Monetary and Capital Markets Department, and he was responsible for the IMF's Global Financial Stability Report. Prior to joining the IMF, Fabio was a Senior Associate Director in the Division of Monetary Affairs at the Federal Reserve Board. He'll be followed by Bill White, who is currently a Senior Fellow at the C.D. Howe Institute in Toronto, Canada. Until April 2018, Bill was Chairman of the Economic and Development Review Committee at the OECD in Paris. Before that, he served in a variety of senior positions at the Bank for International Settlements, where he was one of the few economists who warned of the impending 2008 US housing and credit bust. I'm also pleased to welcome my good friend Alex Pollock, who will moderate this event in his usual inimitable manner. Alex is a distinguished fellow at the R Street Institute, where he rejoined after serving as the Principal Deputy Director of the Office of Financial Research in the United States Treasury Department. I've also had the pleasure of working for many years with Alex at the AEI, where we've hosted a whole variety of events like this. Just by way of introduction, I might say that it would be a gross understatement to say that in the wake of the COVID panic, we lived in the most unusual of economic and financial market times. Allow me to mention three of the more striking aspects of our unusual times. The first is that the United States, the world's largest economy, is engaged in a fiscal stimulus policy experiment of a size that has no peacetime precedent. This is underlined by the recent passage of the $1.9 trillion Biden budget stimulus package. Together with the December 2020 bipartisan stimulus of $900 billion, the Biden budget means that in 2021, the US economy will receive fiscal policy stimulus amounting to a staggering 13% of GDP. To put that into some perspective, the 2021 fiscal stimulus would be some 3 times the size of the 2008 Obama budget stimulus, even though economic conditions today are better than they were in 2008. The second distinguishing feature of today's global economy is that the US fiscal experiment is occurring at a time of remarkably unorthodox global monetary policy easing. It's particularly striking that whereas it took Ben Bernanke's fiscal reserve 6 years to increase the size of the Fed's balance sheet by $4 trillion in the wake of the September 2008 Lehman bankruptcy, it has taken Jerome Powell's Fed barely 6 months to do the same thing in the wake of the coronavirus pandemic. This has now resulted in the US broad money supply growing by 30%, or at by far its fastest pace in the past 60 years. And that expansion is occurring at the same time that the European Central Bank and the Bank of Japan too are continuing to pursue highly unorthodox monetary policies. The third aspect of today's economic times that seems worthy of note is what has come to be called the global everything asset price and credit market bubble, to which years of ultra easy monetary policy has given rise. It's not simply that today's US equity valuations are at lofty levels, last seen on the eve of the 1929 stock market crash, or that the Bitcoin market now has a valuation of $1 trillion. It is also, more importantly, that very risky borrowers, especially in the highly leveraged loan market and in the emerging market economies, have been able to raise vast amounts of money at interest rates not much higher than those at which the US government can borrow. It's also of deep concern that world debt levels today are at record high levels. All of this raises a number of questions which I've asked the panelists to answer in the following order. The question for Jeffrey Frankel is, how likely is it that the Biden 1.9 trillion budget stimulus package will lead to an overheating of the US economy and to higher inflation? The question for Fabio Nattalucci is, how overextended are US and world asset credit markets? How are these markets likely to respond to high US interest rates? The question for Bill White is, how resilient would the world financial system be to a bursting of the everything asset price and credit market bubble? What are the risks of another great global financial market crisis? And the question that I've left for myself is, what would be the implications of high US interest rates on the emerging market economies? With those introductory remarks, let me call on Alex Pollock to say a few words and to start moderating the event. Alex, the floor is yours.
Thank you, Desmond, for organizing this most timely and fundamental discussion. As Desmond said, we live in the most unusual of economic policy and financial market times. I'll add to that thought that these times demonstrate that among the most important of financial factors are the fashions and the ideas held by the International Club of Central Bankers. And all current central bankers are the intellectual grandchildren now of President Nixon, who, by reneging on the Bretton Woods commitments of the United States 50 years ago this year and setting up a worldwide fiat currency system for the first time ever in peacetime, made the financial world of 2021 possible for better or worse. Desmond mentioned remarkably unorthodox global monetary policy easing and the size of the Fed, but let's just add up in numbers, and they're going to do it in dollars, the current balance sheets of some major central banks. The Fed is now $7.7 trillion in assets, so it now rounds to $8 trillion. Most of us wouldn't have thought that. The European Central Bank, $8.5 trillion. The Bank of Japan, $6.6 trillion. The Swiss National Bank, which is interesting in many ways, including its $200 billion portfolio of equities, 1.1 trillion, and the Bank of England, 1.3. We add those together, we get a $25 trillion combined balance sheet of major central banks, and that, needless to say, is remarkable indeed. Now, there's no doubt that this expansion has fed the global everything bubble of our conference title. And a year ago this month, as we all know only too well, we had a financial panic. Liquidity became illiquidity with a capital I very suddenly. And that set off the central bank bailouts and renewed expansions that are still with us, renewed because, of course, we had the big expansion after the 2007-2009 housing crisis and then the 2010 to 12 European sovereign debt crisis. Among the most interesting asset booms as part of this is that of US houses, and the housing price boom is fed by the Fed's $2 trillion mortgage portfolio. In other words, the Fed owns 20% of all the residential mortgages there are in the United States. The Fed is still buying, and it has locked itself into a tight embrace with the US Treasury and Fannie Mae and Freddie Mac. You can almost think of those things all making one big consolidated government financial entity: the Fed, the Treasury, Fannie Mae, and Freddie Mac. Having gone this far, how will the central bank club withdraw from its ongoing interventions? Good do. Try to think about. Yesterday, the Bank of Canada's deputy governor rightly said, quote, "Once crisis tools have served their purpose, central banks should scale them back," unquote. But if the crisis tools are what is still holding up asset prices, and we're afraid of asset price falls, and that includes house prices, will the grandchildren of Nixon admit that the time has passed for their interventions, or will they continue? So we will ask on this panel, what lies ahead? Higher goods and services inflation? If so, how much higher? High interest rates? How much higher? Falling asset prices? Liquidity becoming illiquidity once again, or something else that will surprise us again? And our excellent panel will consider the probabilities of these. We'll proceed as follows. Each speaker is going to speak about 10 minutes on the question, which Desmond stated. And immediately following that speaker, the panel will discuss the issue and the presentation for another 10 minutes. We'll then go to the next speaker for a 10-minute presentation, 10 minutes of discussion, and so on until we complete the four-member panel. And after that, we'll open the floor to audience Q&A, and we will adjourn promptly at 3:45. To begin the panel, the question for Jeff is, to repeat, how likely is it that the Biden $1.9 trillion budget stimulus package will lead to an overheating of the US economy and to higher inflation? Jeff, you have the floor.
Doing share screen. Can you see my title slide, Alex?
Yes.
Okay, so I want to thank AEI and Desmond for having invited me, and the honor of going first, and thank Alex for moderating. The question that has been assigned to me, as you've just heard, is how likely will Biden's $1.9 trillion relief package, they prefer to call it a relief package rather than a stimulus package, lead to US overheating and to high inflation? I'll give you my bottom line right from the start. I would say overheating is very likely next year, say 2022, if it's defined as GDP above potential output, the amount of goods and services produced when the economy is operating at full potential, but is rather less likely if overheating is defined as inflation rising a lot, in particular rising above where the Fed wants it to be. The basic logic of why I think we're going to get to output above potential is a Keynesian multiplier logic, and I think Keynesian multiplier theory has been sufficiently well resuscitated that I can actually say the word out loud. It's not a dirty name, Keynesian, I hope. The analysis I'm going to give is pretty familiar textbook stuff of the people, the economists who have been writing about this and talking about it. Larry Summers' column in the Washington Post on February 4th was the most attention getting. The multiplier, we're not sure what it is. Estimates vary, but under recent conditions, it's as high as 1.5. And by recent conditions, I mean interest rates close to zero lower bound, and expected to stay there, at least short-term interest rates expected to stay there. I'm going to use a multiplier of 1 to be conservative, and because a lot of the American rescue plan consists of transfers, and some of those transfers will be saved, and only the amount that's spent enters the spending stream. And also because long-term interest rates may rise, even though short-term interest rates are not going to rise for the next few years. And the 10-year government bond rate is already up to 1.7%, which is almost double where it was in January. Well, if the multiplier of 1 times 1.9 trillion is 1.9 trillion, which is 9% of GDP, which is indeed a very large fiscal stimulus. GDP at the end of 2020 is estimated to have been about 3% below potential. I'll show you a graph of that in a minute. So if you add 9% stimulus effect on the economy, you get from 3% below potential to 6% above potential by next year. So that's the basis of my asserting that, even if the multiplier is less than 1, you're still going to get above potential. Here is a graph of the output gap, the difference between actual output and potential. In late 2019, the GDP was 1% estimated above potential, and record plunge in the second quarter because of the coronavirus recession, leaving us 10% below potential. We've come back a fair amount since then. According to this is potential as estimated by CBO, Congressional Budget Office. The beginning of the year, GDP was about 3% below potential. So if you add a 9% boost, you get well above potential with just about any multiplier. Now, the major counter argument that has been made to this is that we may be underestimating potential GDP. It's certainly true that the methodologies and the specifics of estimating potential GDP are highly uncertain. We can give you a whole range of estimates. And one piece of evidence why we might be estimating potential GDP is that inflation did not rise much in 2018-19 when GDP was estimated to be 1% above potential. So maybe in retrospect, it wasn't. Maybe we were underestimating potential and underestimating how low we could drive the unemployment rate, which was 3.5% at the lowest before the pandemic, before inflation accelerates much. Well, in my view, I don't think we're estimating potential GDP by that much. A better explanation of the failure of inflation to rise in the 2018-19 is we have quite a flat Phillips curve. After all, before there was the puzzle of why inflation didn't rise in 2019 more than it did, there's a puzzle of why it didn't fall more than it did in 2010 to 2014, even though output was still below potential. In the aftermath of the global financial crisis, unemployment was declining from its 10% peak, but only slowly, and was still above what we considered to be the natural rate, and output was still below potential. And yet inflation didn't fall very much. So only a flat Phillips curve can explain both of these events. And that's the reason for my second part of my conclusion, that even though I think GDP in 2022 will rise above potential, I think it is much less likely that inflation will rise above what the Fed wants. It will rise probably somewhat above 2%, but the Fed wants it to get above 2%, and so that seems like not very damaging. And the reason for the Phillips curve being pretty flat is presumably that expectations are well anchored. The red crosses are inflation expected for the next year as a result of the gathered by a survey, and the green line is market-based expectations of inflation, and those do not they're pretty stable, even while inflation itself fluctuates a bit. So if inflation is not going to be out of control, what's the problem? There are other possible downsides to so big an expansion. According to CBO, U.S. national debt as a share of the economy, the ratio of debt to GDP is passing 100%, will be well above 100% by the end of this year. And that's the highest it's been since 1945, after the borrowing to fight World War II, and the highest it's been in U.S. history on record. Now, this is perfectly sustainable, as many economists have pointed out in recent years, part of the whole secular stagnation discussion. If interest rates stay so low, if they stay below the growth rate, then the path is sustainable. But it's unsustainable if interest rates rise. This is especially an issue for other countries. I'm going to leave other countries to other panelists to discuss. It's less of an issue for the US because we have the exorbitant privilege. We can get away with the things fiscally that other countries can't, but it is an issue. Well, the alternative to interest rates rising and entering into a possibly explosive path, ever rising ratio of debt to GDP, the alternative is the Fed succeeds in keeping interest rates low. Jay Powell has pledged to keep short-term interest rates down for about 3 years, and quantitative easing is still in effect to help, and forward guidance to help keep long-term interest rates from rising much. Let's say the Fed succeeds in keeping interest rates low. Well, then it may prolong what this session is in the series at AEI is calling the everything bubble, especially the U.S. stock market. But we've already heard from Alex, and we'll hear from the other 3 panelists about the role of U.S. monetary policy and interest rates on the so-called everything bubble. Number 3, the trade deficit will rise if the budget deficit rises. Some of the increased spending will fall on foreign goods. Now, that doesn't bother me as much as it bothers most people in the political system. Actually, under these circumstances, it would be a good thing. It would be a safety valve or an outlet for the overheating, and would help keep inflation down. But one downside, even under that view, is it would exacerbate protectionism, which is already a danger. And then lastly, one must say, whenever one starts talking about, or people start talking about the sky's the limit on spending, government could get sloppy, and it depends how the money is spent. If it's spent on worthwhile things, and Biden's stimulus is aimed at the coronavirus, at making sure we're all vaccinated, and retrofitting schools for air ventilation, and alleviating poverty, which is not directly the fighting the coronavirus, but it's estimated that child poverty will be cut in half, and I'm in favor of that. But there is always a danger, which I view as less severe with this administration than sometimes in the past. But there's a danger that the money will be misspent. All right, my last slide.
It's good because you're on to your last half a minute here, Jeff.
Okay. The mistake of 2009, and I haven't done a Google search, but this phrase has come up very frequently lately. And they're talking there about Obama's $800 billion stimulus that was passed as soon as he took office at a time when the economy was in free fall. In retrospect, or some people say, Paul Krugman says, I told you so at the time, it was too little. And I would specifically emphasize it was too short-lived. It only lasted 2009, 2010, and then was discontinued. It did help end the global financial crisis recession in 2009, the second quarter. The timing is just perfect. And I think whether you look at growth rates or change in employment or the financial markets, it's hard to deny that it played an important role, along with Fed easing and ending the recession. But the recovery was much too slow. Now, I'm not sure that the mistake was Obama's. The people in the Obama administration would say that it was the most he could get passed politically through Congress, given Republican opposition. Maybe it was his mistake to try to do it on a bipartisan basis, but regardless of where you locate the mistake, the country as a whole made a mistake in having the stimulus in 2009 be not bigger than it was and not longer lasting than it was. And clearly what's going on is Biden is making sure that the country doesn't repeat the mistake. And I, on net, would approve of that.
Time's up.
And I'm finished.
Thank you. Okay, let's go on to, thank you, Jeff. Let's go on to Fabio. And your question is, how overextended are the US and world asset and credit market bubbles? Excuse me?
Are you not having a discussion of Jeff's question?
Oh, I'm sorry. Thank you. Good heavens. You're so right. Discussion of Jeff's question. Fabio, won't be on for 8 or 9 more minutes. Let's open the panel for any comments on Jeff's question. Thank you, Desmond. Who would like to start on the panel?
I'd be happy to just make a comment or two on Jeff's presentation. I'm not sure that I'm quite as sanguine about the inflation risk as Jeff is. Partly because of one of the reasons Jeff says is we're giving the equivalent of 9% of GDP stimulus when the gap is only 3%. So even if you just look at the fiscal stimulus, you're going to be way above potential, and you'd expect that to cause inflationary pressure. But I would add that what one's got to be looking at is the context with which the fiscal stimulus of this size is being done. There's a huge amount of pent-up demand in the economy as a result of the coronavirus pandemic. Savings rates in the United States are unusually high, something like 6-7 percentage points of GDP higher than they normally are. So you can expect that as we get people vaccinated, we're going to have that pent-up demand coming on top of the fiscal stimulus. And then, as I mentioned in my introductory remarks, we've got monetary conditions that couldn't be easier. So this, to me, looks like it's a real combination, that Biden doesn't want to repeat Obama's mistake. He just wants to make a bigger mistake on the other side, which I'm not sure that I understand the logic. I would just end by saying that I'm not sure that we get necessarily inflation, because what this is likely to do is it's likely to force up market interest rates, which is what we're already seeing, market interest rates going up because they think that there's an inflation risk, the Fed is behind the curve. And my fear is that higher interest rates will burst the bubbles, in which case we won't get the inflation. But if we abstract from the bubbles, I don't see how we don't get a lot of inflation with this amount of stimulus coming from fiscal, monetary, and pent-up demand. So, but I leave it at that.
Jeff, you want to reply there?
Yeah, well, two points. One is if you're worried about a bubble, then I would, due to excessively easy monetary policy, then you might welcome a little bit of bursting of the bubble better sooner than before it goes farther. On inflation, I think we're not sure. In the 60s, we had the slippery slope of ever rising inflation until it got to very high levels, of course, and we had to pay a pretty big price to bring it down. Ultimately, the recessions of 80, 81, 82. So a lot depends on how sustained this is, because inflation doesn't rise suddenly, and its expectations, I think, are well anchored. There is uncertainty.
That's for sure. Other comments on Jeff's question or his presentation?
Could I?
Go ahead.
Go ahead.
I was just going to make a couple of points. One, I think re-emphasizing the importance of the policy response. Right, this was an unprecedented crisis in terms of impact. Even despite the policy response, the global GDP was down 3.5% last year. We had almost 85% of country below the inflation targeting, and so that was despite the policy. So that unprecedented crisis required an unprecedented response, not only just monetary policy, fiscal policy, also financial policies, which is something that we haven't discussed here. So I think it's important to look where markets are, right? So if you look at for example, inflation break-even markets in the US, and you look at the 5-year inflation break-even, those have been coming up, but they're coming up also because there is a recovery in place in the US and the oil prices are going up. If you look at the 5-year forward, those have been kind of stuck. This is Professor Frankel's point. The inflation expectation actually seems to be quite anchored. And so by some measure, you can look at inflation derivatives like caps and floors. They all seem to point into inflation to be at least moderate. So to me, the true question is, what can we look from the past and learn? And what is different this time? So the past tells us that we took the unemployment rate from 10 to 3.5, and maybe the Phillips curve was flat. The importance of globalization, the importance of optimization. Now, but there are also differences. You have very high savings rate. You have very hard uncertainty about the outlook. And so how that is going to play out with the new average inflation targeting of the Fed. I think that's going to be the big question, how the Fed will be tested if when inflation starts coming up.
Yeah.
Okay, thank you. Bill, you want to have a comment?
Yeah, I can't remember one of these advertising guys many years ago who said that the problem is that nobody knows nothing about anything. And I think we overestimate our understanding of these economic processes. The particular point that I would make, and I guess I'm probably the oldest guy in the panel, I don't know, but thinking back to the Volcker years, I remember the lead up to what the Volcker policy. And the reason why there was such hesitancy was everybody said at the time, the Phillips curve is flat and inflationary expectations are stable at a high level. And if we try to bring inflation down, the cost will be enormous. And finally, Volcker said, I'm going to have a bash. And it turned out that both of those assumptions were wrong. And it strikes me that it is not implausible that as it were, ramp the policy up in the opposite direction, that we'll find that our underlying assumption was wrong there too. Jeff has mentioned the fact that maybe we might be underestimating potential. I guess I would say I think there's a reasonable chance that we're overestimating potential, because all of those things that in a sense gave us low inflation over the course of the last 2 or 3 decades, they're all going into reverse. So globalization is turning into deglobalization. The demographic bonus is now going in the very opposite direction. It's well documented in that recent book by Charles Goodhart. We've got climate change, which is going to be enormously costly, and is going to push potential down, not up. So there's all sorts of reasons, I think, why it's legitimate to worry about an inflationary outcome. And lastly, I mean, Jeff, you mentioned the fact that it matters how the money is spent. Well, one of the things, of course, that Larry Summers was concerned about in that Washington Post article was that all this 1.9 trillion is basically being spent on income support, in very large part. And what Summers was worried about was we're supposed to be having a $3 trillion package that actually affects the supply side of the economy coming down the road. And it might never happen because the money's already been spent in ways that are not going to increase our productive potential going forward. So I'm sort of with Desmond. I'm not saying that it will come back, but I think the concerns that people are raising are perfectly legitimate.
Thank you, Bill. And that brings us to the end of our discussion session here. I'll only add that looking back over financial history, what I observe is that, as Bill said, we are not just once in a while, but all the time surprised at how little we know and how things come out that we don't expect. So personally, I wouldn't be surprised if the general expectations about inflation were surprised and it gets much higher. But we'll proceed now to Fabio. And Fabio's question is, how overextended are the US and world asset and credit market bubbles? How are these markets likely to respond to higher US interest rates? Fabio.
Thank you so much. Thanks for the invitation, and it's a pleasure to be here. I'm going to try to share the screen and bring up my presentation. Can you see the slides?
Yes.
Yes, you're good to go.
Okay, thank you. So what I'm going to do, I'm going to quickly summarize how the impact of supportive policy that we've been discussing so far, and then highlight 2 themes that may be relevant here. One, briefly, the divergence in the recovery across countries, regions, and sectors, and then particularly possible unintended consequences of policy as it relates to asset creation. So we already discussed this. There's been a huge increase in central bank balance sheet for the G10. It's about almost $10 trillion increase that has resulted in an easing of financial condition, as you can see in the middle, across the world, maybe with the exception of China. See this huge spike in tightening of financial condition early 2020, and then an easing of financial condition, which is particularly remarkable for the US, and that's the black line. And the main driver of the easing of financial condition has been, one, the reduction in interest rates, so the central bank cutting monetary policy rates, as well as a recovery in asset valuation, both equities and corporates. And that's the decline in the red bar. Now, this has been particularly important because it allowed markets to reopen. So policy responses allowed the household and firms to continue to receive credit, in some sense provided a bridge to the recovery. You can see the reopening markets quickly in terms of issuance of global high-yield bonds to the left, to incredibly high levels, close to $1 trillion, as well as global equity issuance to the right. In emerging markets also, the emerging markets have also benefited from the improvement in global risk appetite. In 2020 has seen record high issuance, both for corporates, that's the red bar, as well as for sovereign, that's the green bar, and 2021 has also started on a pretty strong footing, as shown to the left. Obviously, in some of these emerging markets, we have seen outflows from non-residents, investor, and domestic banks have played an important role in picking up the slack, and they now represent a significant share of holdings of sovereign bonds. So the question I want to ask at this point are, one theme again, it's one of asynchronous divergent recovery between advanced economies and emerging markets, but also within countries, within regions, and within sectors. Then the second theme is the one of the unintended consequences of policy. So policy has been definitely positive, has allowed to bridge to the recovery. We have to deal with an unprecedented crisis, but there may be also unintended consequences of keeping rates so low for so long, of central bank being so active in terms of assets. I'm going to look into the equity market as well as credit markets, then conclude with a sense of what could be the implication of rising US interest rates. Now, in terms of global equity markets, we have seen a rotation out of the equities that have benefited since the spring of last year, primarily information technology and tech, into sectors that would be benefiting from the recovery. And if you look at the performance by sector, that's what is shown in the middle. So between March and November, big improvements in information technology, industrial, consumer discretionary, materials. But since November, you see other sectors that actually have come back in terms of performance. So energy, financials in particular. Now, if you decompose the return of the S&P 500, and that's what is shown to the right, you can see that the ramp up in the S&P 500 in terms of return has been driven primarily by one, lower interest rate, that's the green bar, at least until last year, has been by compression of equity risk premium, so a pickup in investor risk appetite, that's the gray line, as well as most recently an improvement in the earning outlook. So by helping compress equity risk premium and support investor sentiment, as well as improving the outlook, that policy support has in some sense provided a boost to equity returns. Now, the way we think about equity valuation, the assessment is that valuation may be stretched, and that would be one of these unintended consequences of policy. There's two ways to look at it. One is to look at where equity valuations are compared to some fundamental based model. So what is shown to the left here is that valuation appears to be stretched, and an important driver of this overvaluation is uncertainty. There is so much uncertainty in terms of earnings, for example, that valuations seem to be stretched compared to the way they should be based on fundamentals. Another way to look at this is to compare what you get in terms of yields, global equity earning yields. So think about earnings to price and compare to real yield. This is essentially the way of saying that real yields are so low that despite paying high prices, equity returns are still attractive. The gap between the green line and the blue line. Now, if we switch to the corporate bond market, we see a similar improvement. To the left, you see the corporate bond spreads have contracted quite significantly, both for investment grade, the blue line, as well as the high yield, the orange line, despite the fact that there's been a ramp up in speculative grade, for example, in the global speculative market. Now, those are 12-month trailing grade. Defaults have come down, so eventually they will start coming down, but still, you see significant increase in default rates, particularly in some sectors. This is the point of the divergent recovery. So oil and gas last year, consumer products, media entertainment, and retail. So how to think about where credit valuations are is to think about in terms of what models tell us, for example, with respect to fundamentals. So the chart in the middle shows the actual spread for investment grade bond in the US, that's the orange line, compared to what the model would tell us. A model where spreads are calculated based on fundamentals, based on uncertainty, amount of leverage at the corporation, as well as policy support. Now, the gap is the gray line. The gray line being negative, or the gray area, would suggest essentially that spreads are too compressed compared to fundamentals. Another way to do it is to look to the right. It's say taking high yield spreads, taking out some estimated measure of expected compensation for default, and look at the difference as the credit risk premium. So the additional compensation that investors require for bearing credit risk. And you can see that after a jump in early 2020, that credit risk premium appeared significantly compressed there. That means not much compensation for bearing credit risk is being asked by investors now. Now, there was a mentioning of the leverage loan market at the beginning, so I thought it would seem interesting to spend 1 minute discussing leverage finance. Leverage finance is the sub-investment grade of corporate debt in the US. So you can see to the left that there's been a notable compression of spreads, both in the high yield bond market, the green line, as well as in the leverage loan space, and also looking at a structured product, for example, CLO, so collateralized loan obligation. You can see that AAA spreads have compressed meaningfully. They're now almost back to where they were. Part of it is driven by fundamentals. The chart to the middle shows you that there is an improvement in the credit quality composition of the underlying loan pool in CLOs. So the share of loans accounted by CCC or D essentially is coming down, as well as the share of loans with negative outlook. At the same time, we see a deterioration of credit quality, for example, as measured by leverage multiples, a continuation in some sense of a trend that has continued from before. So going back to the rates market, we have seen a significant steepening of the yield curve, right? So the front end of the curve it's compressed, it's stuck where it is in response to communication and guidance from the Fed. But we have seen about 75 basis point increase in the long end. And as I mentioned before, a big chunk of this is driven by real rate as opposed to break-even. Break-even seems to be more or less where the Fed long run equilibrium would be, but this increase in real rate, it's what may be challenging risky asset valuation. Going back to the chart I showed you before between the difference between earning yields and real rates. This increase in real rates could be something that could challenge essentially risk asset valuation. The other way to look at this is to look at
Fabio, you're in your last minute.
Okay, thank you. So the other way to look at it is to look at whether this is driven by the expected policy path, for example, in expectation of improved outlook and the Fed tightening, or by increase by term premium. And it seems that the term premium are the main driver of the increase in long-term yields in the US, which could bode not particularly well for risk asset prices. And finally, to conclude, one comparison that is often drawn is with the taper tantrum back to 2013. The chart to the middle shows you that in terms of rising rates, we are essentially on the same path with the taper tantrum of 2013 in terms of speed of increase. And the speed is what is a concern here, not so much the increase in rate if the outlook improves, but it's the speed of which, over the narrow window over which that increase in rates is occurring. That said, and I conclude, one big difference is back then in 2013, when US rates came up, we have seen significant outflows from fixed income mutual fund in the US. That's what is shown in the upper part of the right, while in this case, we continue to see significant inflows into investment grade, for example, despite the increase in rates. That's all.
Okay, thank you very much. We'll move to the panel. Comments on Fabio's presentation, or on the general topic of what will happen if these interest rates go significantly higher, another tantrum or what? Anybody? Bill?
Yeah, when you look back on the history of all of these recent sort of financial crises, to me, they always sort of, they all look the same, in the sense that, you know, going back almost 20 years, if not longer, prior to the crisis, you get all of the stuff that we have seen quite recently, which is a narrowing of the spreads, an increase of the equity prices, the VIX goes down. everything sort of moves in a direction where it looks as if things are okay, and then they aren't. And so again, I mean, I don't want to go to the point where you start talking about sort of what's the word, using them as a contradictory device, you know, narrowing the spread sort of is the good news. I'm not saying that's necessarily bad news, but historically it has frequently been the bad news. There was an element too, I thought, Fabio, of suggesting at the beginning that maybe the equity prices were not really highly valued relative to, given the fact that the long bond rates were really as low as they are. But that's like saying we don't have a bubble in the equity market because we got a bubble in the bond market. And that, I think, is what Chairman Greenspan, for example, you know, has been repeating, that the fundamental problem is really that the long rates are too low. And I would say under the influence of concerted central bank expansion, and not just in the past year, but over many years, and that's the thing that we really have to worry about, that particular bubble will reverse. And when or if it does, it'll take the rest of us down with it.
Other thoughts?
Alex.
Yes, Desmond.
Yeah, I agree with Bill that, you know, it appears in some ways similar to past experiences before we've seen bubbles burst, but I think that this time is different. You know, I thought that what Fabio's slides are showing is the pervasiveness of the bubble, you know, and the size of these bubbles. You know, that is what disturbs me, is it's not just in the equity market, it's not just in this pocket of the credit market, but it's pervasive and it's on a scale that is quite enormous. So that is my concern. And the other concern is, you know, like you say, is that there is a bubble in the bond market, and that bubble is about to be burst by a fiscal policy that is just so expansive. You know, if you're running a budget deficit that's now 13% of GDP, it would seem to be basic economics that you can't expect the interest rates to stay where they were before you had this kind of fiscal expansion. Yeah. So it really comes down to a view, you know, how much do you think the economy is likely to be overheated? How much do you think the interest rates are going to rise? And I found that slide by Fabio, you know, of interest, that we're seeing the interest rates backing up at this same pace as we saw in the taper tantrum, and we're really only at just the beginning of this. So I'm not sure that I see how this ends too happily.
Yeah.
Maybe the extravagant privilege won't bail us out this time.
Yeah.
Can I respond?
Go ahead. Yes, please.
I think we need to put the experiment here in context, though, right? So the counterfactual without massive policy support would have been a much deeper hole in terms of global growth, right? Despite policy support, we got down -3.5 last year. And so I think keeping financial condition easing, it's the intended objective of policy to keep markets going and the flow of credit back to firms and households. The question is, there may be some unintended consequences, and how should we deal with those unintended consequences? I don't think tightening financial condition and slowing down growth is the answer. I think growth is a necessary ingredient for financial stability. The issue is how to keep growth going and addressing these financial vulnerabilities that are rising. And there are other tools that can be exploited and used, and some countries are using, some in the macroprudential policy sphere, for example, to address some of this. I think tightening policy and tightening financial condition to prevent bubbles and tanking the economy, I don't think there will be a road that would take you down necessarily to a better place at this point.
Okay, thank you. Other comments, Desmond?
Yeah, you know, I agree with Fabio that one really did need to have a very strong policy response in March last year, you know, at the depth of the coronavirus crisis. But I think it's quite another matter to think that you need massive policy stimulus at this stage of the game, you know, and that we've really got to look at the size, you know, that if we're talking about $1 trillion, that's a very large budget stimulus, you know, that you might need. But I guess my problem is that we're in a very much better position than we were in 2008, yet we've got a fiscal stimulus now that is 3 times the size of what we had in 2008. So it looks to me like one's really playing with fire. One's really going to be forcing the interest rates up. And if the Fed doesn't move, those interest rates are going to go up at an even faster rate, because the market is going to be saying the Fed is just clueless. They're behind the curve, and we're just going to be dumping these bonds. You know, we're going to have the bond vigilantes coming back. And I'm just not sure that the Fed's in a very tight box. You know, they damned if they do, they damned if they don't.
I think that's why it was important. I was trying to show, and I apologize, I got to the end, but trying to decompose the increasing rates, right? Because it does matter, first of all, the speed of acceleration of the increasing rates, right? Whether you do it over a window of time or whether it's a very fast increase. And 2, what is driving the increase, whether it's perception of improving the outlook or whether this is primarily term premium and maybe having to do with fiscal policy. Those considerations are important when you look at the rates, not just the rates are going up. And whether it's real or not, the real part increase may actually question more the valuation of the equity market, for example. Real rates are coming up like that. So sorry I got there to the end and I didn't have enough time, but that was what I was trying to do.
Good addition. Other comment? I'll say on the question of rates, I remember a while ago, several years maybe, Desmond wrote me an email and it said, the 10-year treasury is going down to 2%. Which seemed absolutely unbelievable at that point. And I didn't believe it, and he was right and I was wrong. Now we think 2% would be very high and an amazing increase in rates. But it's not very high. And later in the panel, maybe we can all make a forecast of a year from now, what we think the 10-year treasury is going to be. And we'll write them down and then lose the notes. Any other comments on the on question 2 before we move on here?
Yeah, could I just note actually that I have no objection to a crisis response, which is significant and of required magnitude. And I think sort of what the Fed did, for example, in 2008, 2009, what's been done this last time up until now has been totally appropriate. But the point to remember, and it goes back to the point that Fabio made about unintended consequences, is that crises by definition only last a short period of time. And then afterwards, you should be thinking about the medium-term consequences of the stuff that you've done. And similarly to 2008, where I guess monetary policy morphed into a decade of support, you know, building on the initial interventions that had to do with lender of last resort. It went on for a decade, which struck me as strange. And I guess maybe what Desmond's saying, it's the same kind of thing now, that what was done was the appropriate thing to have done. But the question going forward is, in the light of all of the possible unintended consequences, and I'll talk about that, is it the right thing to do what they're currently doing? And I guess there's some questions.
In other words, how do you stop your intervention once you've done it? Let me thank the panel for a good discussion on that one. Fabio, thanks. And Bill, we're going to go right on to your comments and your question, which it flows logically, as you say. And your question, just to repeat it, is how resilient would the world financial system be to a bursting of the everything asset and credit market bubble? And what are the risks of another great financial market crisis?
Well, let me begin by saying I apologize for getting in so late. I didn't realize that there was only 4 hours between the East Coast and London, where I currently am, and so nor did I get the chance to do a kind of preview. So I've got some slides. And let's just see whether I can make them work. If I can't, I'll have to do without them. So now I want, where do I get my slides?
Share screen.
Yeah, I did share screen, and I'm now looking at, how do I bring these things up? Well, listen, let's just forget about it. Let me just sort of go into my the comments that I want to make. Even before the pandemic hit, it struck me that we had an economy that was effectively an accident waiting to happen. And the elephant in the room, and people have mentioned it, but I want to sort of really lay some stress on this. The elephant in the room, of course, was debt. And global debt ratios, I think as of 2019, at the end of them, of 2019, we're already 320% of global GDP. And that was up something like 40 percentage points from the end of from the beginning of the global financial crisis. Okay, so if we were thinking about the global financial crisis as being a period of deleveraging, the very opposite was the case. And unfortunately, that increase in debt, and I know Desmond's going to talk about this, was led in very large part by the emerging market economies. So that whereas in 2009, they were part of the solution to the global financial crisis, today they're part of the problem. And that was all sort of before the pandemic hit. And my take on that is that easy money had an awful lot to do with that increase in the debt ratios. Because basically what you do with easy monetary conditions is you induce people to bring spending forward in time. And unfortunately, if the money's used in unproductive ways, and we just spoke about the fiscal side, but I think there's been a lot of unproductive spending going on over the course of the last 10 years. What you wind up with then is these debts grow and become headwinds. So that in the end, you get to a situation where your monetary policy has ceased to be effective. And I'll get back to that in a few moments time, that maybe we are actually at a point where further monetary stimulus actually wouldn't do any good because it's been losing effectiveness over the course of the years. And it's also worth noting that it leads to a lot of debilitating side effects. And those too have been building up over a very long period of time. And one of the things that I think we have to be concerned about is financial fragility. We have been observing over the course of the last decade or two, profit margins of financial institutions have been declining because of the squeezed margins. We've been observing a lot of these guys, the life insurance companies, the pension funds and others searching for yield in ways that they've never done before. And all of that, I think, has led to a degree of fragility on the financial side that might yet come back to haunt us. A second consideration is that easy money, and this goes back to Hayek in the 1930s, can lead to all sorts of misallocations of capital. And we've seen a huge expansion in zombie companies, not just in Europe, but in Japan, but in Europe, in the United States, in Canada, where I come from. We've seen a lot of misallocation of new money. Think about the number of these big companies like Uber and Netflix, and I don't know how many of them that are spending billions and billions of dollars, and none of them have made a profit or look likely to make a profit. So big misallocations. And lastly, there's the exit problem. So that if you get all of these imbalances in the economy arising out of easy money, you get into a situation where you've gone so far down the road you can't get back out. So that the central bankers are increasingly saying, we think we might want to raise interest rates and to tighten up, but we can't because we just create the crisis that we're trying to avoid. So I think the monetary policy sort of created sort of morbidities, if you want to put it that way, that mean that whatever happens, a potential end of everything bubble, the implications of that could actually be very severe because the underlying problems like a morbidity in COVID-19 have been building up over the course of the years. And so I don't want to put all the blame on the central bankers in terms of as it were, weakening the underlying fundamentals. So let me say a few bad words about the regulators while I'm at it. And what I want to say basically, and I've got a big paper on this. You can read it and either agree or disagree. It's up on the INET website. The paper is entitled "Why International Financial Regulation Still Falls Short." And the basic hypothesis is that not just have the measures taken themselves perhaps been inadequate, and I'm thinking about capital ratios. Like, we know capital ratios are much higher than they were, but as Martin Wolf put it in a recent article, he said, tripling almost nothing does not give us very much. So that's a problem. The regulators have looked at this zombie company thing where the banks have been sort of evergreening loans. They've let it go on. They ought not to have done, but they've done it because it's been an easy way out. And I think most importantly with respect to regulation, and this is an absolutely fundamental point, is that it has very much had the nature of what the British would call whack-a-mole. So you deal with one problem and then the problem moves elsewhere. And so in a nutshell, what's happened is we've got very serious efforts to improve banking regulation. And what's happened over the course of the last 10 years is there's been a massive shift away from banking to market provision of finance, non-regulated or largely non-regulated. And there's also been a massive shift within the financial institution lending out of banks to non-bank financial institutions, many of whom have got the same characteristics as banks. That is to say, they're subject to runs. So when things, or if things turn sour, the idea that the financial system is now stable and in good health and no bad things can happen, I think we need to rethink that. We really need to rethink that hypothesis. So that the fundamentals, if the economy gets hit by another big shock, are not good. Well, what are we going to do about it when the time arrives? The honest truth is kicking the can down the road might still work. You know, you can conceive of a situation where the growth comes back fast enough and sustainable enough, and the interest rates stay low enough, long enough, that we can actually grow our way out of this. This is not impossible. But I guess the point that I would make is that it is also very easy to see how things could come unstuck. So on the one hand, it may be that the rebound that we see will peter out and the future growth prospects, reflecting deglobalization, demographics, etc., will not be so good. And at that point, I think the chickens will clearly come home to roost. And the banks will have to stop evergreening. The capital will have to be reconstituted. That is not a good news story. But the honest truth, as I see it anyway, is that if too slow growth can be a problem, too rapid growth can be a problem. And that brings you back to the stuff that Desmond was just talking about, which is that if you do get an uptick in inflationary expectations, this could cause interest rates to rise in a way that, given the burden of corporate debt that's already out there, to which Fabio has referred, and the other imbalances in the economy, that we
Bill,
could have
one
real
minute,
problems.
maybe you're there.
Yeah, and I'm just about there. And so we have some real issues there. The path getting through to sustainable growth has been getting narrower and narrower because of the debt accumulation and the other imbalances. And I think there's a reasonable chance we're going to fall off that path, either on the inflationary side or on the deflationary side. So we've got some big problems going forward, and it is not so clear what one could do to extricate ourselves from that situation. Clearly, one big element of it would be there will have to be a lot of debt restructuring and debt resolution. And unfortunately, even though the IMF, the BIS, the OECD, and the Group of 30 have been drawing our attention to the fact that our administrative procedures are greatly deficient with respect to debt restructuring, not least for sovereigns, and I guess Desmond will come to that. We've got a problem without a very evident solution. So should the everything bubble burst, even in the context of accelerating growth, I think we should be thinking about the possibility of things still going seriously wrong.
Thank you. All right, for members of the panel, comments on Bill's presentation and thoughts. Jeff, yeah.
Yeah, I'll make two comments on Bill's, as always, good comments. He said that tremendous monetary policy easing, which we had in reaction to the global financial crisis 2008, 2009, including some unprecedented steps, was appropriate then, but that it lasted too long. I'm not sure how long he means. If you could talking about 2019, you could make a case that it was a wrong time for easy monetary policy at the cyclical peak. But if we're talking about 2013, 14, 15, to say the obvious, unemployment was still high, though it was coming down, but it was still high. The recovery was painfully slow. Everybody perceived it as such. And inflation was didn't fall very much, but didn't rise, so that I would support that continuation of quantitative easing, or the policy path chosen by the Fed, I think was about right. The other one was, I agree with him completely on the need for financial regulation, and he's been very good on this for a long time. Other countries, particularly even something maybe we should learn from emerging market countries, they follow counter-cyclical regulatory policy, what we call macroprudential policy, tightening up bank regulation and margin, tightening up mortgage, down payments or on housing and stock market buying on credit, tightening all that up, but especially on the banking side during the boom, and then loosening during the downturn. I think we really have a lot of trouble with that in the US, where there's hardly even an attempt to make it countercyclical. There was some in Dodd-Frank, but during the peak of the cycle in 2017, 18, 19, we were undermining Dodd-Frank and chipping away at it, and the counter-cyclical buffers and the capital requirements were not adequately used.
Yes.
So I think we could do better in the U.S. maybe by taking a page from some of the emerging markets and trying to be counter-cyclical on our prudential financial regulation.
Yeah.
Bill, a response on that?
Well, I just on the business about whether monetary policy was too easy for too long a period of time. What's interesting today, of course, is that so many people are saying that during that period, indeed, too much reliance was put on monetary policy, that the big mistake was not to recognize that there was still more room for maneuver on the fiscal side and not to rely totally on the monetary side. And I guess all I would say is that that argument seems to me to be a statement that it should have been done differently way back when.
If I can just do a quick response, I agree with that completely, and I agreed with it at the time that zero lower bound monetary policy was much less effective, and the job was fiscal policies, but fiscal policy was completely constrained. was the counter argument, and it was correct. Especially after Republicans.
Why do we think it was constrained then, Jeff, if it's not constrained now?
Biden succeeded in getting through a big fiscal stimulus now, and Obama was constrained by Republicans in Congress and was not able to get it through as big a fiscal expansion as the model said. And
I was really sort of thinking more globally, that you remember that sort of around 2010 or 2011, the G20 with the US at the forefront had used fiscal expansion. And then I think around 2010 and 2011, the whole thing globally went into reverse. And I suspect that, I don't know this for a fact, but I suspect that the troubles in Europe had led the Germans to convince everybody that unless they restrained and practiced austerity, that they were all Greece. But there was a global shift at the time. And I guess all I'm saying now is that I think the economists amongst us are saying, well, that was a mistake. But I totally agree with you. I mean, there was also this political problem in the US. But maybe that was because they were, what's the word? The Republicans were listening to the scribblings of some economist, as John Maynard Keynes might have put it.
Let's see if we have other comments from the panel. Desmond, and then Fabio will come to you.
Yeah, Alex, I just want to say I very much agree with Bill's presentation. I share most of his views. I think that he's right to highlight the problems that we've got in the non-bank part of the financial sector, that unregulated part is where you're really going to get problems. I guess where I would differ with Bill is that I'm not sure that kicking the can down the road is really going to help this time around, and that we can expect to grow our way out of these kind of problems. When you look at emerging markets are just awfully compromised. But I'd say that another big part of the global economy that's in deep trouble is the European economies, that they back to the problems that they had in 2010. They stuck in this fiscal straitjacket. Their public finances are just totally out of whack. I don't see how they can possibly grow, stuck in that straitjacket. So, I think that if you've had bad lending for very many years, the chickens are going to come home to roost, and I think they come home to roost sooner rather than later.
Thank you.
I'm just trying to be positive about things, Desmond.
I know the feeling.
There is a chance, but I would make the point again that kicking the can down the road one more time, it almost basically implies that there might be still bigger, longer term problems coming down the road if you do that.
Fabio, you've been waiting.
So maybe a couple of points. One on the financial vulnerabilities. I think I completely agree, and then maybe that's one way to broaden the concept of unintended consequences. That these vulnerabilities have been rising. Some of them were elevated even before COVID, right? So corporate debt is a good example. And clearly, yes, in the short term, it helps to rebuild liquidity buffer by borrowing, but debt levels continue to rise. And that's one topic, if I may, that it's analyzed in the upcoming Global Financial Stability Report. So we'll be releasing 2 chapters next week, one on corporate debt and one on commercial real estate, looking exactly at these issues. The second point on the financial regulatory policies, I think perhaps I have a more positive view on the banking side. I think if you think about the size of the shock, post-GFC regulatory reforms must have done something good, because we haven't seen a financial crisis on the banking side. In fact, they managed, sure, there were a lot of policy that helped cushion the impact, but we haven't seen major strain in banking. I completely agree on the MBFI side, though. When people go back and say, well, things work, it worked because the central bank backstopped the entire financial system. But I think the question is, one is whether the regulatory perimeter around MBFI is where it should be or should be broadened. So if you benefit from lender of last resort policy, perhaps you should look inside the regulatory perimeter. And two, whether we have the tools to address some of vulnerabilities in the NBFI sector, even if you bring them inside the regulatory perimeter. And I suspect the answer is no for some jurisdiction and for some NBFIs.
The IMF, could I say, Fabio, the IMF has done a very good job in the recent financial stability reports, which I've read with great interest. But there are still problems, I mean, that you yourselves have been pointing out, and I'm thinking particularly in Europe, where this nexus between the banks and the sovereigns is, I think, a source of great concern to the Europeans themselves. And I think has actually been getting worse, not better, in the course of the last few years. And that's something that we'll all have to watch out for.
At this point, I'm going to bring our discussion, which has been very lively and good, to an end so we can let Desmond have his turn. I do just want to make one historical point on the kicking the can down the road. The 1980s had two experiments, at least in this country, in the US, with kicking the can down the road. The banks were probably insolvent in 1982 when the sovereign debt collapsed. Volcker led basically a falsifying of the accounting statements and loan evaluations to kick the can down the road for 6-7 years and until the workings out of the LBC, as we then say, debt. So that kicking sort of worked. At the same time, the Federal Home Loan Bank Board, the then regulator of the savings and loans, tried to kick the can down the road with the savings and loans, and it only got worse and finally utterly collapsed. So as Bill says, it's hard to know whether the kicking the can down the road will work or not. With that, let me come to Desmond. Desmond, what would be the implications of higher US interest rates on the emerging market economies?
Thanks, Alex. I thought that it's worth talking about the emerging markets for a number of reasons, that this is a topic that generally is somewhat neglected. And I find it surprising, because what one can have is real systemic consequences, spillovers to the rest of the global economy from what's happening in the emerging markets. What we've now got is a situation where, because of rapid growth over the past decade or two, emerging markets are now half of the global economy. So what occurs in them is pretty crucial. The other reason that emerging markets bears looking at closely is what Bill has alluded to, is the highly indebted position of these economies. So we've already got record debt levels in those economies. I was struck, you look through the IMF's fiscal monitor, the number of emerging market economies that now have debt levels that are approaching 100% of GDP, public debt levels, that is really unheard of for emerging markets. That normally is when you get into trouble. And it's of concern that something like $4 trillion of that debt is dollar denominated. So if you get a rise in the dollar, we've got a real problem. The other reason that emerging markets now need to be looked at closely is that they've just been hit by a perfect storm. I'd say many of those emerging market economies in Latin America, in Africa, have been hit by a perfect storm of the current COVID crisis itself. Then they've had low commodity prices. They've had their markets drying up. They've had lack of remittances. So that's really made their situation worse. What we're seeing right now, Fabio just pointed that out, is that you're seeing long-term interest rates rise very rapidly in the United States. That generally is not a good idea for emerging markets. You get those interest rates, if you get rising interest rates, it complicates their public finances, but it also gets capital to come back. You get the sudden stop. And you've also got the dollar now rising, which once again makes it difficult for them to service their dollar-denominated debt. When I put all of that together, the basic question that I have is if emerging markets today have very much worse fundamentals than they did in 2013, and if we're now getting interest rates set to rise at a faster pace or at the same kind of pace as we had in 2013, why aren't we going to get an emerging market crisis? You know, that we've already got all of these emerging markets. We've got so many more of these emerging markets troubled than we had in 2013. In 2013, we had what was called the Fragile Five. This time around, you're talking about the whole of Latin America, you're talking about the whole of Africa, you're talking about countries like Turkey. It just looks to me like this is a very much larger problem. And of course, what it's occurring is it's occurring in the context of credit problems in so many other parts of the economy. So emerging markets could very well be the trigger that sets this whole process off. I thought that what might be worth doing is just looking very briefly at two very large emerging market economies. You know, that if you look at Brazil, which is by far the largest country in South America in terms of its economy, and you look at South Africa, which is the largest of the African economies, you know, neither of those have a look in very good health right now. So what you've got in both of those economies, COVID has hit them really hard. They've got very deep recessions. They've both got now budget deficits that are around 15% of GDP. They've both got public debt levels that now are around 100% of GDP. To make matters worse, they don't have their COVID under control. You know, both countries, this COVID pandemic is far from under control, and they've both got political problems that are going to make it very difficult for them to address their public finances. So their public finances are totally unsustainable. And the only thing that has been keeping the show going is low interest rates. You know, so we've already had a situation of what occurred immediately during the pandemic. March and April, you had record outflows from the emerging markets. But as soon as the Fed began expanding its balance sheet, as did the ECB, what you've got is you've got the bizarre situation of countries having increasingly deteriorated public economic fundamentals, yet capital flowing to them at sort of record rates. You know, so this is really not a good situation. You're really just making these awfully bad loans, you know, which aren't going to get repaid. And the problem is what happens when the music stops. You know, so as the music stops, as you get the higher interest rates, as you get the dollar strengthening, that is when we're really going to get problems. So, you know, if I'm right that we're going to see inflationary pressures in the United States leading to higher interest rates, we're already going to have emerging market problems on a big scale. You know, I'd just stress a point. You know, everybody seems to think that it depends on what the Fed does. You know, I think that if the Fed does not act in a preemptive kind of way, we run the risk that the long-term rates in the United States go higher than they would otherwise have gone, and you're just going to get the money coming out of these emerging markets, and we're going to be getting problems there. So, you know, in short, that's basically how I see the situation. I see emerging markets got higher debt levels than they had in 2013, very much worse public finance fundamentals. And now we've got the risk that interest rates in the United States are going to go high because of an excessive fiscal policy here. So I'm not very optimistic as to where this all plays out.
Thank you, Desmond. Comments from the panel?
Well, I would just add to what Desmond said was that I think in 2019, the fund basically suggested that 40% of low-income countries were either already in debt distress or at risk of being at debt distress. So even before the pandemic, as indeed with the advanced market economies, there were deep problems that were already building up, and the pandemic is just sort of the the poisonous icing in a poisonous cake.
Other comments?
Guess to say, I'll try to say something a little more encouraging about emerging markets generally, that to my mind, after the international debt crisis of the 80s and the currency crisis of the 90s, many emerging market countries learned some lessons. And since, after the turn of the century, adopted stronger policies, not all of them, but some of them, more flexible exchange rates, higher levels of reserves, higher ratio of reserves to short-term debt in particular, less dollar-denominated lending, borrowing, more borrowing in their own currencies, especially when it's public sector debt, which is what we've been talking about, less pro-cyclical fiscal policy. Now, I share some of the same worries about the current situation, and especially countries that Turkey and well, South Africa and Brazil were mentioned. I mean, all of them have put themselves in a vulnerable situation, in Argentina by virtue of the policies. But I think for many other emerging markets, they're in a stronger position than they used to be in the 80s and 90s, and that's partly why they're able to respond counter-cyclically and run up big budget deficits, as more appropriate in response to the pandemic than was appropriate in earlier episodes. Having said that, the role of easy money coming from the Fed in allowing them to sustaining their borrowing can't be underemphasized. And I share the concern that if and when I guess interest rates go back up, that it could precipitate some more emerging market crises.
Thank you. We can certainly say that historically speaking, defaults on sovereign debt are very common, and in these sorts of countries in particular. So it wouldn't be unprecedented by any means to see them again. And Max Winkler, writing in 1933, talked about the temptation of all politicians to run up debt and have their countries become insolvent. He said, from Abyssinia to Zanzibar, in 1920, in 2020, I suggest we can update that to from Argentina to Zaire, since both of them defaulted on government debt last year. This is
Zambia.
one of the Zambia. I'm sorry, Zambia. Thank you. Got the wrong Z. Thank you, Jeff. You're right. Zambia it is. A to Z anyway. And these kinds of defaults certainly are a relatively frequent, historically speaking.
Well,
other comments on emerging countries? Yeah, Bill.
I just add that these bankruptcy procedures, that we've got a greater need for restructuring. But over the course of the last number of years, of course, there's been an increased amount of private sector, non-bank money going into many of these countries. There has been an indeterminate amount of Chinese money going into many of these countries. And the real problem is that you want a restructuring that's orderly, and you want people to sort of get together and do a deal and figure out how to get out of it. But of course, if everybody's looking over their shoulder, the public sector is looking over their shoulder at the private sector in the West is looking over its shoulder at the Chinese, everybody's trying to gain the advantage and be the free agent, we have another set of problems that we didn't have before. And that doesn't say, and that doesn't say anything about the famous, MNL versus Argentina case. So there's some procedural issues out there too that are new.
Well, I don't know if it's new. I mean, private sector involvement, either narrowly defined or broadly defined, was an important component of the response to the international debt crisis in 1982, and to some extent the East Asia one. But this time it's harder, maybe because of China is the biggest debtor, the biggest creditor, yeah. And so far the steps that the IMF and the G20 have taken have not been enough in terms of not covering private debt, I don't know how much China's participating, and not including the bigger middle-income countries.
Yeah.
I was going to say, Desmond, we should give you the last word on emerging markets, and then we're going to go on to our Q&A.
Yeah, well, I just would say two things, in terms of what's happening in emerging markets right now that is disturbing. At the time that interest rates are rising, they're doing a lot of damage to themselves. That I'm thinking right now, a large emerging market like Turkey, Erdogan is, what he's trying to do is to test whether his theory is right, that interest rates aren't so much the cure for inflation, but they're the cause of inflation. So in the middle of a currency crisis, he's suggesting you cut interest rates rather aggressively. He's fired his central bank governor. That really brings Turkey to the fore. Turkey looks like it's going to be the first large emerging market country that's going to have really a full-blown currency crisis, capital controls, the whole sort of thing. And Brazil, you've got a political situation that's not going to let them deal with their problems. Just the last point I'd make is, in relation to Jeff's comment about the 1980s and the debt crisis, I think now it's a lot more difficult, because most of the financing isn't bank financing, it's bond financing. You've got all of these different bondholders with different interests. It really is going to be a real mess to try to restructure a country like Brazil's debt. It's going to be with us for a while.
But on the plus side,
hey, Jeff, we got to cut us off and get on to give the audience a chance here, and we can have some fun together later. Thank you. Ladies and gentlemen, we have time for some Q&A now as we get to the last 10 or 13 minutes of our program. I do want to ask one question of the panel to start with. I mentioned before that we used to think that a 2% 10-year treasury rate was unimaginably low. In fact, we couldn't imagine it. And now we think it's high. So I do want to give the panel, any member of the panel who would like a chance to forecast the 10-year US Treasury rate 1 year from now. So 1 year ago, needless to say, we were in the middle of a financial panic and crisis. 1 year from now will be March 2022. Who'd like to make the forecast of the 10-year rate? And then we can think of, if it is that, what that would mean for various overextended asset prices in emerging markets. Any takers?
It all 2%.
Jeff?
Alex?
Yes.
I'm glad that you didn't ask for the trajectory of the 10-year rate. That would have been a little bit more complicated. But with my view of the world, I'm fairly confident that we're going to see long-term treasury rates again below 1%. And that is simply because if you do get these bubbles bursting, you are going to get another round of quantitative easing, pumping up the economy, to keep the show going. So I think that it's going to be at 1%, but I'd suggest that
in between, it'll be higher.
Before you go long treasury bonds, wait a while, let them go up a little bit before the bubbles burst.
My forecast is at least 100 basis points higher, which would be, let's say, 2.6 or 2.7%, which would still be extremely low. That would give us approximately 100 basis points higher on mortgage rates, which will clearly dent the housing bubble. And on another panel, Bill, we're going to get you to talk about the Canadian housing bubble too.
What Canadian housing bubble?
All right, let me come to audience questions.
Dare you, sir?
We see if we can get through these. I'm going to take these in the order in which we received them. To the panel, how much more can the US debt to GDP ratio rise before the US dollar begins to lose its status as the global reserve currency? Anybody?
the U.S. can get away with a lot of things that other countries can't, and I was for years thinking that we were approaching the limit, and that turned out to be completely wrong. I think particularly the sign that the world is not running out of patience with the U.S. Or maybe they feel the patience, but their main problem is there's not an obvious alternative to challenge the dollar. Every time risk goes up, there's a flight to quality, which safe haven, which is into the US dollar. And that happens even when the uncertainty arises from something in the United States. I mean, what stronger signal could you have? And that pattern still holds. So I'm done forecasting the decline.
Well, your forecast is it could go a lot higher and it wouldn't dent the international role.
Yeah,
but Alex, there's a broader issue here too, of the everything else, everybody else is doing it issue. So when you think about people saying, I'm going to flee the US dollar, the question is, who's, even aside from the underlying structural questions about liquidity, whatever, other people are following policies. Other big respectable people are following policies that would have been considered just as imprudent 20 or 30 years ago as the US is. So this raises another question with me. When you think about individual countries behaving badly, so you have fiscal dominance and you have the central bank picking up the tab. Traditionally, the way that it works, of course, is that people get frightened, they flee the currency, and then you're into hyperinflation. And we have all sorts of books and lots of history on this, right? But where do you flee to when everybody's doing it? So it may well be that if you had a degree of international cooperation to keep on doing what everybody's doing, this process could go on for a long period of time before you actually get some serious inflationary implications, because the escape valve is closed. There's no place to go.
I guess if we had a Bitcoin advocate on the panel, he would say you have to flee to private currencies.
right, but that's a bubble too.
It is a bubble too, I agree.
Oh, yeah.
All right, let me come to the next question. Thank you. Next question from the audience. What is the likelihood of a severe recession that will accompany an interest rate correction? I think that was a question for you, Desmond.
I would say that the probabilities are really very high. So it's just a question that these bubbles are just so much bigger. I guess my way of thinking would be that if we look at the problems that 2008 bubble in the United States caused for the rest of the world, why, if we've got larger bubbles in very many more places, aren't we going to get another global downturn? So I think that if these bubbles do burst, we certainly would have a problem. But I would just add one factor that might be relevant, to the earlier question about the dollar. It goes along the lines of what Bill's saying is it's not simply what other countries are doing, but for the dollar to depreciate, some other currency has to appreciate. And when you look at Europe, Europe looks to be in just so much worse shape than the United States, from a debt point of view or from a growth point of view, that
a vaccination point of view.
A vaccination point of view, the whole spill. I don't see the euro being a serious challenger to the dollar anytime soon.
Can I try to answer that question in slightly different ways? I think there are not all interest rate increases are equal. There are also good reasons why rates may go up, right? So if you get growth coming back, in fact, you would want rates to go up because that would be helpful to take away some pressure on these financial vulnerabilities. So ultimately what matters is what happens to financial condition. Financial condition, it's a complex indicator that summarizes rates, but also asset valuation, equities, corporates. If rates go up, if the economy is coming back strong in terms of growth, and financial condition remain supportive of growth, I think that would be a positive outcome, even if it's accompanied by higher rates. If higher rates instead turn out into declines of risk asset and financial condition tightening, that would hurt back. in terms of growth. So I think framing in terms of what growth is doing and the reason why rates go up, I think it's important to answer that question.
Okay, thank you. Other comments on this one? Okay, we'll go on to another question from the audience. How important were supply side factors in the slow recovery after 2010? And what does the current, well, that's one question. And it continues, what does the current dilemma imply for the European Union's search for a new framework of fiscal rules? Well, I guess we could answer either or both of those, any member of the panel. Want to take that up? Supply factors in the slow recovery of the 2010s and or European Union search for fiscal rules. Any comments from the panel?
I think the European fiscal rules are pretty much shot. It's hard to see. I mean, they were violated repeatedly in the past, and it's hard to see after this big relaxation getting back to them. And if this results in this crisis results in a greater degree of, provided there's a political consensus to support it, of a greater degree of fiscal authority at the federal level, at the pan-EU Euro level, that could be a good thing.
Yeah, well, certainly the Europeans are, excuse me, are certainly open to thinking about doing things differently. The fiscal responsibility board, I can't remember, but Niels Thygesen is the head of it, has just come down with a bunch of recommendations that basically suggest a fundamental rethink of the Growth and Stability Pact, which is a good thing. And in addition, of course, the fact that the Europeans have come up with or the Germans have indicated their willingness to go along with the $750 billion euro package that will come out of Brussels and will be financed out of Brussels is also a good thing, because now we have, what's the word, a liability of the Union, which is truly a liability of the Union in the same way as the US dollar is a liability of the federal government.
I might call that the Alexander Hamilton moment of the European Union, I guess.
Yeah, or not, because of course Alexander Hamilton also took on the state's debts and also provided
yes
taxes that would be able to finance the feds.
Yes.
Of course, the Europeans have not yet done, but who knows? Maybe that's coming down the road.
Okay, other comments on these questions either?
Alex, I think that it's important when you're looking at these countries and you're thinking of how they're going to change their fiscal rules, is to look at what position they're in right now. And if you look at a country like Italy, which is the third largest country in the Eurozone, you're talking about a country that's got a public debt to GDP ratio that's now 160% of GDP. It's never been this high in its 150-year history. And on top of that, it's running a budget deficit of 10% of GDP, and it's stuck in a currency, in a euro straitjacket. So it's very difficult to see what are you going to do? Are you going to allow this debt to keep on rising indefinitely? Are you expecting the ECB to continue to buy these bonds? I'm not sure that I see an easy way out for the Italys, the Spains, the Portugals of the Eurozone. That when it's not really the fiscal rules that have to change. It looks to me as if it's the currency system itself that is in deep trouble.
Thank you, Desmond. We're down to our last minute here, so let me thank the panel for a really excellent discussion, obviously very knowledgeable discussion. And with a few seconds left, Desmond, since you are the organizer and host, why don't we give you the last word if you'd like to make a concluding parting shot here.
Well, the only thing that I can do is to suggest to people either a good whiskey or two would help them, or else resort to prayer, because it seems to me that we're really in deep trouble.
Thank you. For all of you who've joined us, thank you very much for being with us. Thanks again to AEI for hosting this, and to all of the members of the panel. Thank you.
Thank you very much.
Good evening, all.